Welcome to The Explainer. So India's latest budget just dropped, and the big headline isn't some crazy radical change. It's more about steady hands at the wheel. So today we're going to break down exactly what that means for everything from manufacturing and big infrastructure projects right down to your wallet. We'll turn this whole fiscal roadmap into a story that actually makes sense.
All right, let's dive right in. Finance Minister Nirmala Sitharaman has laid out the budget for the new fiscal year. And really, you can think of this as the economic blueprint for the entire country for the year ahead.
So, what's the big theme here? Well, it's pretty interesting, actually. If you remember past budgets, they sometimes had these huge shakeups, especially with things like income tax. Not this time. This year is all about continuity. The idea is to build on what's already been done, to stay the course, not to introduce a bunch of brand new disruptive policies.
And this quote from the finance minister really hits the nail on the head. The whole objective is to keep that momentum going, that 7+% growth we've seen recently. So the strategy isn't to rock the boat. It's to double down on existing reforms in public investment and domestic manufacturing.
Okay, so how is this whole plan structured? Well, the government has laid out its economic roadmap, and it's built on 6 core pillars. Let's take a look at what they are.
So these 6 areas are pretty much the foundation for everything in the budget. It covers the whole gamut, from boosting the economy to managing the nation's finances. Now, for this explainer, we're going to focus in on the announcements that have the biggest impact. We're talking the big push for manufacturing, the massive spending on infrastructure, the tax changes that might affect you, and of course, the government's overall financial report card.
First up, let's tackle that first pillar, sustaining economic growth. And a huge piece of this puzzle is a renewed, really targeted push for domestic manufacturing under the whole Make in India banner.
You can really see they're attacking this from a few different angles. You've got these huge strategic plays, right? Like the brand new semiconductor mission, but then you also have these super targeted, almost surgical incentives. Think about it. They're getting rid of customs duties on specific parts for things like microwave ovens. That's designed to pull in very specific kinds of manufacturing. And extending the export window for garments, that's a direct shot in the arm for that industry's global push.
And inside this whole growth pillar, we heard a significant new term, Bharat Vistar. This is a pretty big deal. It signals a major effort to modernize one of India's most critical sectors, agriculture, by bringing in cutting-edge tech like AI to boost yields and make things way more efficient.
Of course, all that manufacturing needs a solid foundation to stand on, right? And that brings us perfectly to the second pillar, infrastructure. And let me tell you, the government is planning to spend big.
And the headline number here, wow, it's a massive 12.2 lakh crore rupees set aside just for capital expenditure. Now, just to be clear, this isn't money for paying salaries or daily running costs. No, this is cash being poured directly into building the country's future. We're talking about the roads, the railways, the ports, the kind of long-term assets that are going to fuel growth for years, even decades to come.
So where's all this money going? Well, the budget lays out some seriously huge new projects. There's a brand new freight corridor that's going to connect the industrial hubs of West and East India. We're also seeing 7 new high-speed rail corridors announced, and a major push to develop inland waterways for transport. And it's not just about the big cities. They're making sure smaller Tier 2 and Tier 3 cities get significant infrastructure upgrades too.
Another key initiative that popped up is Purvodaya. This is a dedicated scheme that's all about building out the industrial corridor along India's east coast. The goal here is pretty clear: boost manufacturing and port connectivity all up and down that region.
Okay, so we've covered the big picture stuff, manufacturing, infrastructure, but how does this budget actually hit home for people and businesses? Let's get into the tax changes that could affect your finances and the markets.
This is a big one for a lot of people. If you're planning a trip abroad or maybe sending money overseas for education or medical reasons, that upfront tax you had to pay, it's called TCS, or tax collected at source, it's been slashed. I mean, it went from as high as 20% down to a simple flat 2%. That's some immediate cash flow relief right there.
But it wasn't all tax relief, especially if you're a trader in the stock market. There was a pretty significant hike in the securities transactions tax, that's the STT, specifically on derivatives. Now, I know these percentages on the screen look tiny, but don't let that fool you. This move makes trading in futures and options a whole lot more expensive. It's a classic move to try and cool down what the government might see as too much speculation, and it's a big reason why the market took such a nosedive on budget day.
You know, that tax hike is a perfect bridge to our final section.
Let's zoom out and take a look at the government's own books. Where's all this money coming from? Where's it going? And what's the game plan for the country's overall financial health? So where does the government actually get its cash? As this chart makes pretty clear, for every single rupee the government collects, the largest chunk, 24 paise, comes from borrowing. Yep, nearly a quarter of the budget is funded by debt. After that, you've got income tax and corporate tax as the next biggest contributors.
And on the flip side, where does that rupee actually go? Well, the biggest piece of the pie, 22% of it, goes straight to the states as their share of taxes. But here's the part that always gets me. The second biggest expense, a whopping 20%, is just paying the interest on money the government has already borrowed in the past. That's huge.
Now, a really crucial number for judging financial health is the fiscal deficit. That's basically the gap between what the government spends and what it earns. After it shot up to over 9% of GDP during the pandemic, this chart shows a very clear downward trend. This steady reduction is what experts call fiscal consolidation. It's basically the government tightening its belt to get its finances in order. And they've set a new, slightly lower target of 4.3% for the coming year.
And this whole commitment to fiscal discipline is also baked into the roadmap for the national debt. The government's laid out a very clear plan to bring down the total debt to GDP ratio, with the goal of getting it down from over 56% now to about 50% in the long run.
So, let's wrap this up. When you boil it all down, the 2026 budget is sending one very clear message: continuity. It's all about stability, about building on the foundations they've already laid. But that leaves us with a really big question, doesn't it? Is this steady-as-she-goes approach the best way to power India's future growth? Or was this a moment where they could have been bolder, more ambitious, and they missed the opportunity? And honestly, that's the big debate this budget has really set in motion.